Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of January, with the majority of the big banks predicting that inflation would come in at 3.2%. We got our answer at 8:30 when January CPI came in much lower than expected, coming in at 2.9%.
You were warned. I warned you.
Yields on 5-year government bonds fell almost immediately following the release, though still up nearly 40 basis points since the beginning of the year. And while a lower than 3% inflation rate for the month of January will no doubt lead to calls for the Bank of Canada to move up rate cuts, again, some, including Pedro Antunes of the Conference Board of Canada, says that the real story for Canadian interest rates lies in the United States.
Let's not kid ourselves. The U.S. has a big influence.
So what I want to do today is go over Canada's inflation data for the month of January, delve a bit deeper into that data as we've seen something similar to this before, discuss some pressures coming out of the United States, and then go over what to look for next. Speaking of next, as we'll discuss momentarily, today's inflation data does not necessarily mean imminent rate cuts are coming to a theater near us. We will continue to track Canada's inflation rate and the Bank of Canada's response stemming therefrom on this channel throughout the year. Click like and subscribe if you want to get those updates, but for now, let's get into this data. On to the data. As mentioned, Canada's inflation rate came in at 2.9% in January, much lower than the 3.2% being predicted by the big banks. The biggest contributor to the decline in inflation was gas prices, which were down 4%. This was followed by slowing food price growth, which, according to Stats Canada, slowed down to 3.4%.
Oh, that's a crock of
Yeah, more on that later. And the good news wasn't just with headline. Core inflation, which strips out those measures of food and gas, and also the measurement which the Bank of Canada looks to when deciding whether or not to lower interest rates, also fell substantially as well, with CPI median falling from 3.5 to 3.3 and CPI trim falling from 3.7 to 3.4. So, headline inflation down in January, led in large part by declines in food and gas prices, and core inflation was also down as well, down to its lowest point that it's been in at least the last 12 months. So, the Bank of Canada will be making its rate decision on March 6, with an inflation read coming in below 3%. Should we be expecting rate cuts at that meeting?
I'd stake my reputation on it.
Well, yeah, the usual suspects will no doubt be out in full force, claiming that an inflation rate below 3% means the Bank of Canada will have the all clear to start cutting rates. But we've been here before, with headline inflation coming in at 2.8% in June of 2023, and premature celebrations ensued. And the Bank of Canada is going to remember this as well. As mentioned, much of the reduction in headline inflation came from falling gas prices, which was also the story in June of 2023. And while food price growth as of right now is in better shape than it was in June of last year, as of late, gas and diesel prices are on their way up. Further, food prices could be on the rise as well, as the blackout period for price hikes ended on February 1st. This is why the central bank pays attention to core, as gas and food prices can swing wildly. And while measures of core inflation are down since December, they're still up almost 3% from March of last year and up 2% from June of last year. Make no mistake, we are seeing progress in the CPI as well as measures of core inflation, but we've seen this before, only to see those measures reaccelerate. As such, as even noted by Deputy Governor Gravel in December when referencing June's below 3% inflation, 1 month does not make a trend. And this concern that inflation could reaccelerate is especially the case when we look at the US, where, over the past week, the CPI and PPI, the Producer Price Index, both came in much hotter than expected, leading the markets to push back bets of when the Federal Reserve was going to cut rates.
Come on, who are you going to believe? Those
Pedro Antunes, chief economist at the Conference Board of Canada, was quick to note this in the immediate aftermath of the CPI release this morning.
It's really important, that how inflation plays out in the U.S. And we know that the U.S. continues to have a fairly strong labor market, as do we, in fact, here in this country. But the inflationary pressures ticked up, and they haven't really seen a slowdown in consumer spending south of the border. So that's been essentially, I think, the bigger concern.
And yeah, we can see this very clear in the bond market. Even with today's drops in the yields on the 5-year Government of Canada bond, 5-year yields are still up 20 basis points since the beginning of the month, as yields shot up on comments from Chair Powell and US CPI. As such, while today's inflation rate is good, the Bank of Canada is going to be paying very close attention to the inflation data coming out of the United States. As we've mentioned before on this channel, the Bank of Canada can hold rates higher than that of the US. Doing so pushes up the value of our dollar, which pushes down the prices of imports, which helps lower inflation. On the other hand, if Canada were to cut rates first, that would put downward pressure on our dollar, which would make imports more expensive, pushing up inflation. As such, as noted by Antunes on Bloomberg, the Bank of Canada Governor Tiff Macklem, is going to be reticent to cut rates before the Federal Reserve does.
Rates come up in Canada ahead of those in the U.S. Even if markets expect that to happen, that puts upward pressure on the Canadian dollar, and that's not a bad thing for inflationary pressures, because that tends to lower the price of imported goods. But I think the bank is going to be very reticent to start to lower rates ahead of anybody else here, especially ahead of the U.S.
So Canada's headline inflation data is down below that 3% mark, but as mentioned, we've been here before. And while the usual suspects will no doubt be calling for imminent rate cuts starting next week, since we've been here before, we know that that's not necessarily the case. Much of it will depend on the following few months' worth of data, and even more of it will depend on the data coming out of the United States. We will continue to track all of that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.